Hey everyone, and welcome. Now, investing in crypto can be exciting and a potentially important part of your overall asset allocation, but navigating the tax regulations around buying and selling crypto assets can be confusing. So today we're breaking down the key differences between how the IRS treats directly owned crypto versus crypto ETFs. My name is Steve Borstein. I'm founder and CEO of RockCrest Financial in Summers Point, New Jersey. And this video is for informational purposes only and not a financial or tax advice. Consult a tax professional for personalized guidance. Direct cryptocurrency ownership means you hold the actual digital assets like Bitcoin, Ethereum, or XRP. A crypto ETF, on the other hand, is a fund that tracks the price of a single cryptocurrency or a basket of crypto assets, and you own shares of that fund. An example is BlackRock's Bitcoin ETF. Now, with direct crypto, every taxable event is a potential tax trigger. This includes selling your cryptocurrency for fiat, like USD, trading one crypto for another, and even spending crypto on goods and services. Each of these transactions creates a capital gain or loss, the difference between your selling price and your cost basis, or what you originally paid. Now, mining and staking rewards, well, they're generally considered income and taxed at your ordinary income tax rate. So let's say you bought $3,000 worth of Bitcoin and sold it for $4,000. Your capital gain is $1,000, which is taxable. If you hold that crypto for less than 1 year, it's a short-term gain, taxed at your ordinary income tax rates. If you hold it for more than a year, it's a long-term gain, usually taxed at lower rates. So one potential benefit of direct crypto ownership is more favorable tax loss harvesting. If you've experienced losses, you can sell those assets to offset gains and potentially reduce your tax burden. For example, if you bought Ethereum for $2,000 and it's now worth $1,500, you can sell it and realize a $500 loss and potentially use that to offset other capital gains. It's important to note, however, that IRS regulations say that the wash sale rule does not currently apply to crypto. So this is a crucial point. The wash sale rule, which prevents you from claiming a loss if you repurchase the same asset too quickly, currently doesn't apply to cryptocurrencies. This is because the IRS classifies crypto as property and not as a security. So this means you could sell your Ethereum at a loss and buy it back immediately and would still be able to claim the loss for tax purposes. However, this could change in the future, so it's essential to stay updated on tax regulations as this loophole could get closed. So crypto ETFs, or exchange traded funds, are different. When you buy a crypto ETF, you're not directly holding the crypto. You're holding shares of a fund. Buying and selling ETF shares triggers capital gains or losses, just like with stocks. The same short-term and long-term rules apply. Some crypto ETFs might pay dividends, which are then taxed as ordinary income. So although the ETF itself might hold and trade crypto, the individual transactions within the ETF are generally not taxable to you as a shareholder. This is a key difference, since you're taxed on buying and selling ETF shares, but not on the internal trading of the crypto within that exchange traded fund. Another critical difference, unlike owning direct cryptocurrency, tax loss harvesting does apply to crypto ETFs. Because ETFs are considered securities, if your ETF shares have lost value, you can sell them and realize that loss. However, since the wash sale rule applies to crypto ETFs, if you sell your ETF shares at a loss and repurchase the same ETF within 30 days, you can't claim that loss. So let's recap. If you're buying direct crypto, you could potentially have more frequent taxable events if you buy and sell. Crucially, the wash sale rule does not apply currently to direct crypto, but it does apply to crypto ETFs. Some other things to consider: direct crypto requires meticulous record keeping. ETF providers, on the other hand, handle the internal complexities of the crypto trading within the fund, but you're subject to the wash sale rule when trading the ETF itself. Remember, tax laws can change, especially in the crypto space. So one of the questions that I get is, which one's better? Well, there's no one-size-fits-all answer. It depends on your investment strategy and your tax situation. Direct ownership gives you more control, but also more tax complexity, especially with the potential for future changes in the wash sale rule. ETFs offer convenience and a simpler tax structure in some ways, but less direct control, and the wash sale rule applies. Consult a tax advisor or a qualified tax professional for personal advice. Thanks for watching, and don't forget to like, subscribe, and hit the notification bell for more crypto content. Let me know your thoughts in the comments. Thanks very much.